Hey, it's Chris Matlashewski with the Built in Calgary team, and this morning I am joined by Joe Jacobs with Mortgage Connections. It's been almost pre-pandemic since our last video call, I think.
Yeah, you bet. Well, thanks so much for having me, Chris.
Yeah, well, I really appreciate you taking time this morning and kind of sharing your insights about what's going on in the mortgage industry. In the last, I don't know, 60 days, we're starting to see, a little bit of easing on single family sales here in Calgary. Our days on market are slowing down. Wanted to maybe pick your brain a little bit about, what may be the responsibility of what's happening in the mortgage industry here. Maybe you can share with us, talk about a little bit about maybe rate increases, rate holds, interest rates, fixed versus variable. Platform's yours.
All right. Yeah, sure. A lot to unpack here. I think we really saw the power of cheap money for the last couple of years. The flurry of real estate transactions, definitely part of that was just money being at absolute record lows. So, we've moved from a very not normal spot with interest rates that were very artificial, just based on governments feeding the market, buying back bonds, all of that. What we're not really maybe expecting is just how quickly we moved out of that environment into the one we're in now. So I think there's a bit of rate shock that has maybe slowed down some buyers. Certainly people that were maybe thinking about buying last year, when they call us and ask about a fixed rate that's now 4.5% to 5%, and when they talked a year ago it was 1.5% to 2.5%, that can be a tough news to kind of swallow on for them. So really what we've seen is two things. With inflationary pressures, and obviously everyone's heard how high inflation is. The government, Bank of Canada, wants to keep that around 2%. It's closer to 8% at basically all-time highs in the last 40 years. So the Bank of Canada has to do something, and their only lever is raising rates. So it's not a surprise that we've seen them aggressively do it. They're maybe a little late to the table and held on a little too long, and that's why you're seeing such big jumps consistently. So that's impacting mainly the variable rates. If you have a HELOC or a home equity line of credit, you're seeing those increases. And we can break those down a little bit on what they actually mean to you from a dollar standpoint. But before I do that, on the fixed side, because that's a different story. What's happening there is the bond market has just gone nuts. So fixed rates are priced off the bond yield, and the spread between a 5-year bond and say a 5-year fixed is the profit for a lender. So you are seeing those rise at very quick pace, and in turn you're seeing fixed rates move with that. So it's a very tough market to navigate right now. If you talk to a bank or your mortgage broker 3 weeks ago and didn't lock in options, there's a very good chance those options are not available. So the biggest advice we're giving any potential buyer is, you need to be more prepared than normal to make sure that you have your financing in place, because it can be a big jump. If you just think, I can get pre-approved, but you haven't actually gone through the process of getting rates held, that budget that you think you're looking at may not be the case. So it's really about proper preparation for people. The other big factor that we're seeing right now is qualifying has changed. So most people that are here have probably heard about the stress test. It's been around for a long time, but it's been kind of stagnant in the sense that people were qualifying at, for a long time here, 5.25. But the stress test is built that it's 5.25 right now, or 2% above contract. So your contract rate. With fixed rates going as high as they have now, if you want to get a 5-year fixed rate, you're qualifying somewhere between like 6.5% and 7%. So that's really shrunk your buying power. And so that's something else to keep in mind, that as rates go up, that test is going to go up unless there are changes that come down the pipe, and that is going to impact what you can do.
Question on that. I've talked to some people, and I've been buying and selling for close to 20 years now. And I've seen rates as high as 7% and as low as like 1.5. In your mind, what should be the standard? Is 4.5, is that a reasonable number? I mean, to us right now, you use the term rate shock. it seems like a high, like we're certainly elevated. But like, what do you feel is a reasonable number that, you talked about inflation, you talked about bond yield, what's a number that sort of, balances out the equation?
Yeah, so I think that's a really good point that you bring up, Chris. We've come out of totally artificial rates. So a lot of the rate shock is just because people had gotten so accustomed to rates being as low as they were. We're really moving to a more normalized rate environment right now. It's just that it's happened so quickly that that's where the shock really is coming. I think we are going to see some settling in the next, 12 to 18 months. And I think you're also going to get just some acclimatation to it from borrowers. Okay, this is what it is. But in general, 4.5% to 5% rates historically are still like very inexpensive interest rates. It's just that we've been in such a low market. So, I think if we're staying in this level, you're not in a spot of real concern. Where concern happens is if, obviously rates continue to go up. That's a really big jump from an affordability standpoint for someone who, a lot of people have had a mortgage for 10 years, have never had a 3 in front of their interest rate. So,
Yeah.
and that's crazy for me to say, because when I've been doing this for 20 years, and when I got into business, I was, refinancing people out of 8 and 9% rates into 6% rates and thought that was great. So, things have just been so low for quite some time. So there's going to be an adjustment. I think, hopefully we start to see some easing on inflation. Obviously, no one knows if that's going to happen. We start to see things settle. We aren't seeing as many rate increases in the last couple of weeks as we have been seeing. So we have seen some settling already, but everything's in flux. So, I think if we can be in that 4.5%, 5% range, that's not that concerning, in the sense that most people that have qualified for a mortgage in the last 5 years have been qualifying at 5% or more anyway. So it's not really that they wouldn't qualify for a mortgage at that level, because the stress test has been at that level. The only concern I have is that if the stress test continues to be priced the way it is, which is 2% over their contract rate, that starts to really shrink their buying power, because now they're qualifying at 7.5% or 7%. And the idea of the stress test was, really to protect people from over borrowing when interest rates were so low. If we're now getting to a more normal rate environment, seeing some sort of adjustment to how they determine that would probably be a benefit to potential buyers.
Yeah, and I think we're starting to see that in, our residential market here, where, product that's priced, 550, 600 and under, as I mentioned, we're seeing a bit of pullback in the number of homes for single family and semi-attached, and but we're still seeing strong performance in, townhome row houses and apartment buildings. So I think that sort of validates a little bit about what you're saying right now. When you're one of the questions that I get, and you're saying that there's been a bit of easing on the quick increases of interest rates there. I'm having these questions right now, and I always defer it over to someone like yourself. And fixed versus variable. A lot of people have been taking advantage of the variable rate. Is this a time that they might want to consider locking in? I mean, historically, again going back. Variable has always performed really well. And, is this a time for somebody, again, obviously, if they want stability and they just want to know what their monthly payments are, fixed, I think, is always the way to go. And, you can budget and work from that. But if somebody's looking to roll the dice a little bit, what are your thoughts, fixed versus variable?
It's a tough question for sure. You're right in your thinking that, over 50 years, the variables outperform the fixed for sure. It really depends where you're at. So a lot of people that are in a variable right now probably have a discount close to 1%, might be a little under that, might be a little more than that. And you're in a really good spot there, because you are getting a discount off prime that is not a normal discount either. So you've started to see the lenders shrink how much they're discounting a variable rate mortgage. So if you're already in a variable, it may make sense for you to ride it out, because you're likely at this point somewhere between 1.75 to 2% lower than where a fixed rate would be if you were to lock in.
Mhm.
So there's still a lot of runway for the Bank of Canada to increase rates, and you still come out ahead. The other thing to remember is just because rates are going up in a variable doesn't mean they're going to continue that way. So one of the things that very well could happen is the Bank of Canada misses the mark. So they're chasing inflation, they're hoping for a soft landing. That may not happen. They may raise rates, to the point where they don't get things fully in line. The economy doesn't perform as well as it is. We get into recessionary in a recessionary environment, and their only lever there to stimulate the market is to lower rates. So you could see a variable go up like it has pretty aggressively and then settle back down by a quarter point or a half a point. The variable also gives you the most flexibility. It's definitely the most nimble product. So you're not you're not going to have as high a payout penalties. You're going to have more flexibility if you do want to do something. So there's still a lot of reasons to stay in a variable. Now, if you're a new mortgage client, you're buying something now, the spread between fixed and variable is not as big necessarily because you're likely not seeing quite as large a discounts. So it's really, a case by case situation on what makes sense. I still am a big proponent that the variable is a great product for a lot of people. It can work really well. The only concern I have is anyone is budgeting their house purchase off today's variable rate, because there's a very good chance that 2 weeks from now it's going to be higher. So one of the strategies we will certainly advise people is if they're comfortable with where a 5-year fixed rate is from a payment standpoint, but they like the variable and they want to, as you said, roll the dice with that, do that, but maybe just bump your payments up to what you'd be paying if it's a 5-year.
Mhm.
While the rates are low, you're just paying that off faster. And you're not going to be budgeting your life around a rate of 2.7 right now, and then a month from now it's 3.7.
Yeah, no, I think that's really good advice. I hadn't actually thought about this, but I was wondering if maybe you might be able to touch in a little bit about residential investors, anything from straightforward residential single family apartments to somebody looking at duplexes, triplex, fourplex. Any advice for investors that are going down that route for financial freedom there?
Yeah, so I mean, obviously rising interest rates impacts your returns here from a is this a cash flowing property? Does this make sense? But there's still a lot of good options for them. I think a lot of investors are more inclined to go fixed than variable, just for the fact that they want to budget things based on that. We're obviously seeing most of them push to 30-year amortizations and that sort of thing as well, just to kind of try to keep cash flow in play. And I mean, this is kind of just leading to another point that I think for any homeowner, whether you're an investor or it's your own property, now the one thing that has happened in Calgary that we haven't really seen in quite some time is an appreciation in value. So if you own a portfolio of real estate already, or if you have a house that you've owned for a few years, you've probably got some equity built up that you maybe didn't think you had. And so we do have a lot of clients now that they're concerned on maybe maintaining payments or rate preservation. If they've accumulated any other debts, those interest rates are also going up. So there is an opportunity for you to do some refinancing too and restructure your setup, whether that's pushing out an amortization as a short-term strategy, just to increase cash flow, or if you have other debts that you want to wrap in. So we've seen some investors doing that where, maybe they have a fourplex and they want to buy something else. They've got an opportunity to take some money out. There's definitely probably some buying opportunities coming up in the market. I think the rental market's going to be extremely strong in Calgary for the next while. Just there's less buyers, but they need places to live. So we are seeing we're seeing some movement here in that regard. And I think that if you continue to have people moving to Calgary, which we're seeing too, they need places to live. So I think there's some opportunities for investors for sure.
Yeah, I concur with that. I've always sort of maintained that, investors say, oh, I'm going to hold off to purchase because, interest rates are going up. And I said, well, why don't you factor in the affordability and look at the vacancy as you touched on? I mean, it's super low right now. If you're on RentFaster or Marketplace, it's your pickings for properties to rent. They're super low. We might have one or two in a community, and whereas this time last year, you might have 5 or 6 to look at, and so I think that this is a time where it does actually favor the investor, even though interest rates are higher. And as you say, your cash flow is affected, but theoretically, through abrasion, your rental rate should be going up.
Yeah, so that's a really valid point, because when you're seeing, I mean, you'd have a better grasp on this than me maybe, but from my view, I'm seeing rental rates up 15-20% in many cases. And so
I'm seeing 25-30 even.
Okay.
Yeah.
So, if you've got that kind of jump, even at slightly higher interest rates, you're still at the same level or ahead. And, you may have less, you probably have less competition on buying these properties right now, because, there isn't as many buyers. So I think there's an opportunity for sure. And, locking in those higher rents will make it still a really profitable venture for a potential investor or a seasoned one.
Yeah, I'm not sure if you can touch on this one. What about developers? Are you seeing developers pulling back, or again, it's one of those things where it's their livelihood. There's still a demand for new product. Are they easing off right now and waiting to see what's happening? You touched on there's opportunity, or maybe opportunity coming down the pipeline because there may be more product coming on the market, more dirt to buy. What's your sense on that?
From what we've seen on developers, I'm not seeing any of them slow down. The bigger issue I've seen from the developer side is just supply issues. So pricing has been an issue for them, in the sense that I've seen a lot of developers hold off releasing or not releasing as much product at one time, just because they're concerned on securing pricing for builds. So we're seeing a lot of developers that have actually held on to maybe inventory lots and released in stages. And depending on where you are, where you're looking to build, there's still massive wait lists. I'll just use Aspen as an example, where builders out there, they've got 20 people applying still for 5 lots. And so they're almost screening potential clients on, it's not just, can you give us a deposit, it's who do we want to work with. So I still think there's a massive demand on the new construction space. The only risk there is there's delays on builds. We've seen that significantly. And so, builds that were taking 8 months are now taking 12. Builds that were taking 12 are taking 14. And so, that's a concern for rising interest rates too, because if you even have a 1-year rate hold and your build's taking 15 months, you no longer have that rate hold. So for buyers, it can be quite a process with the builders now, but I don't see that sector slowing down. I think there's still a significant demand for new product in Calgary for sure.
Yeah. Sorry, just to go back there, I missed that. All right. There used to be the builder rate hold for purchasers, and is that still at 10 months?
So you can do builder, there's some lenders and banks that will do long-term rate holds on builds. Most are somewhere between 6 and 12 months. Very few would do anything over 12 months. And so just the challenge is when builds are getting delayed, we're seeing situations where someone even has a 12-month rate hold and it wasn't long enough. And in the market we're in now, it's a pretty big sticker shock on what their financing costs would look like now.
Yeah, no, understandable. So I guess, moving forward and, talking about what's coming down the pipeline with the Bank of Canada there, where do you see things, landing here in the next 60 days or even 6 months? Crystal ball, of course, but it's Joe Jacobs say.
Yeah, sure. Well, I think I can talk about the next week easier than the next 6 months. I'm very confident we're going to see another increase next Wednesday on the 13th. I think it might be the biggest one we've seen. So the US Fed did a 0.75 jump, which the largest they've done in forever. I think the Bank of Canada may follow suit, a 0.5 for sure. And I think with where things are landing, we're probably going to see a 0.75% increase. So that's a very large jump in one go. Normally when the Bank of Canada is moving rates up or down, it's at a 0.25%. So it's 3 times that. Again, it's just, they are desperately trying to chase down inflation. What does that mean? And I think this is where dollarizing things can help people. A 0.25 point increase in your interest rate is going to cost you about $13 a month per 100,000 you owe. So if you had a $100,000 mortgage, the Bank of Canada increases rates by 0.75%. You're looking at about a $45 increase to your monthly payment. So, if you are in a variable, I do think these kind of rate announcements, if you're in a line of credit, it's a time to review things and make sure you're in a good spot. It may make sense for you to convert to a lock-in rate if you're just at a point where every time the Bank of Canada increases rates, it's causing you great anxiety. That's not where you want to be. But I think we're going to see that kind of increase in the next week. After that, it's hard to say. I think there's still potential, some room for them to have to move it up a bit. I do think you're still going to be in a better spot if you're in a big discounted variable than where fixed rates are, just if we look at the math on it. But the difference is shrinking. I think you could see another, 1.5% from where we are today over the next 12 to 18 months, depending on how things settle from an economic standpoint.
Yeah, no, that's good advice. So if somebody wants to take advantage and get a rate lock tied in, and with Stampede coming up, we always anticipate a little bit of pullback. People go into Stampede mode, or they get out of the city. And so the next 30 days may be advantageous for somebody to lock in a rate hold and purchase a home or an income property. How can they reach out to you? What's the best way to connect with you?
Sure. Yeah. 100%. If you're at all looking, making sure you're doing those steps to get a pre-approval and an actual rate hold is key. But yeah, you can reach out to me just at joe@mortgageconnection.ca. That's probably the best. And we'd be happy to help for sure.
Cool. Joe, I appreciate you taking the time this morning, and we'll see you out there, and happy stampeding.
Yeah, hopefully see you out there. I'm gonna try to limit my stampeding, but I'll be out there a bit for sure.
Cool beans. Cheers. Thank you.
Okay, thanks so much. Take care. Bye-bye.
Bye.